The Roosevelt Hotel in New Orleans opened in 1893 at 123 Buron Street in the Central Business District and operated for more than a century as the social, political, and cultural center of a city whose relationship with its most famous hotel was unlike the relationship between any other American city and any other American hotel. The Blue Room, where every significant figure in Louisiana politics had conducted the conversations that mattered. The Sazerac Bar, which had given the world's oldest cocktail its most permanent address. The lobby, which during the Sugar Bowl and the Mardi Gras season became an extension of the city's street life in ways that no physical barrier could fully contain. Huey Long had essentially governed Louisiana from the Roosevelt's corridors. The hotel was not merely a building. It was a civic institution whose physical address was incidental to its function as the place where New Orleans conducted its most important business, its most consequential politics, and its most celebrated social rituals. It was sold, renovated, closed, reopened, rebranded, sold again, closed again, damaged by Hurricane Katrina, renovated again, and eventually reopened as the Roosevelt New Orleans, a Waldorf Astoria hotel in 2009, under the ownership of a group that included Starwood Capital Group as the primary financial backer. The forensic entry point for this case is not the hurricane. It is the specific mechanism by which a hotel of genuine historic and civic significance passed through multiple ownership structures across the second half of the 20th century, each of which extracted value from the institutional identity while deferring the capital investment required to maintain the physical standard that the institutional identity required, until the accumulated deferred investment and the specific damage of Hurricane Katrina produced a renovation cost that the hotel's revenue potential, even at the apex of its institutional authority, could not service at the terms the renovation financing required. The Roosevelt was too important to close permanently. It was also, for most of the period between 1965 and 2009, too financially complex to operate profitably. Those two facts, held simultaneously, are the forensic architecture of this case. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Roosevelt Hotel's ownership history between its 1893 opening and its 2009 Waldorf Astoria reopening is a compressed version of the pattern this channel has documented across multiple luxury hotel case files. An institution built in one era of American hospitality, operated through multiple ownership transitions that each extracted value from the institutional identity while deferring the capital investment required to maintain competitive relevance, until the accumulated deferred investment made the renovation cost disproportionate to any realistic revenue projection. The specific pattern at the Roosevelt had a Louisiana political economy dimension that other case files have not documented. The hotel's position as the center of New Orleans' political life had made it simultaneously more important than its financial performance warranted and more difficult to manage than a conventional hotel business required. A hotel whose lobby is functionally a public square, whose bar is a civic institution, and whose ballrooms host the events that define the city's social calendar generates a category of value that conventional hotel financial analysis cannot adequately capture. Because the civic value accrues to the city rather than to the owner, and the revenue that accrues to the owner is insufficient to service the capital investment that the civic standard requires. The covenant that the Roosevelt successive owners had not read carefully enough was the one written into the relationship between civic importance and financial sustainability. A hotel of genuine civic importance will always find an owner who values the civic importance enough to acquire it at a price reflecting that importance. That owner will then discover that the financial returns available from operating a civic institution in the hospitality format do not service the acquisition price that the civic importance commanded. The hotel's closure and deterioration in the years before Hurricane Katrina reflected the specific outcome of that cycle played out across multiple ownership transitions. The institutional identity had sustained acquisition interest at valuations that the operating performance could not justify, and the successive owners who had acquired at those valuations had found the investment irreconcilable with the financial returns the market could generate. Hurricane Katrina's August 2005 damage to the Roosevelt accelerated a renovation timeline that deferred investment had already made inevitable. At what point does a hotel's civic importance become a financial liability rather than a financial asset for the private owner responsible for maintaining the physical standard that importance requires? Leave your analysis in the comments below. The appraisal methodology that governed the Roosevelt's post-Katrina renovation financing reflected the specific challenges of valuing a hotel whose institutional significance commanded a premium over its physical characteristics that conventional hospitality appraisal methodology could acknowledge, but not adequately quantify. The renovation cost for the Roosevelt, which required the comprehensive restoration of a century-old hotel structure to the contemporary luxury standard that the Waldorf Astoria brand requires, was estimated at approximately $145 million, a figure that the hotel's stabilized operating performance at its historical occupancy and rate levels could not service under any conventional debt structure. The Waldorf Astoria affiliation provided a brand premium that the renovation financing required, the ability to project post-renovation average daily rates and occupancy levels consistent with the Waldorf Astoria competitive set rather than with the Roosevelt's historical performance in the New Orleans luxury market. The Waldorf premium was real. The New Orleans luxury market's capacity to sustain it was more uncertain. New Orleans is not New York or Paris. The pool of travelers whose travel patterns and price sensitivity place them in the Waldorf Astoria demographic is smaller in New Orleans than in the markets where the Waldorf brand was built, and the seasonal concentration of New Orleans travel demand, in the Sugar Bowl, Mardi Gras, and Jazz Fest periods, produces revenue peaks and troughs that stabilized annual performance metrics obscure. The renovation financing's stabilized revenue projections treated the Waldorf brand premium as a permanent feature of the Roosevelt's competitive position, rather than as a cyclical enhancement whose realization depended on the sustained recovery of the New Orleans hospitality market following Katrina's disruption. That treatment was the specific appraisal assumption that the subsequent years of operation tested, whether the Roosevelt, as a Waldorf Astoria property, could sustain the average daily rates and occupancy levels that the renovation financing required across the full annual cycle, rather than only in the peak periods that the city's event calendar concentrated. The hotel has continued to operate under the Waldorf Astoria flag through multiple subsequent ownership transactions, generating the revenue that the institutional identity and the brand affiliation combine to make achievable. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. Starwood Capital Group's involvement with the Roosevelt Hotel illustrated the specific challenge that institutional capital faces when it acquires a hospitality asset whose value is substantially rooted in its civic and historical significance rather than in its financial performance. Starwood Capital, distinct from Starwood Hotels and Resorts, whose brand portfolio includes the Westin and Sheraton chains, is a private equity real estate firm whose investment thesis is fundamentally financial. Acquire distressed or underperforming real estate assets at prices below replacement cost, invest capital to restore competitive performance, and realize value through sale at the improved operating performance's implied capitalization rate. That thesis is appropriate and has been successfully executed across a wide range of real estate asset categories. It is specifically challenged by hotels whose value is substantially non-financial. The Roosevelt's value was substantially non-financial. The Blue Room's significance, the Sazerac Bar's history, the lobby's relationship to New Orleans civic life, these were genuine and durable sources of institutional value that a private equity real estate firm could acknowledge in its acquisition analysis, but could not generate returns from in the format that private equity return expectations require. The institutional denial embedded in the Starwood Capital involvement was not a failure of financial analysis. The financial analysis correctly identified that the Roosevelt's institutional significance would support renovation financing and would generate stabilized operating performance at rates consistent with the Waldorf Astoria brand. The denial was the assumption that private equity return expectations were compatible with the time horizon and the revenue profile that a civic institution in the hospitality format requires to generate its value. Private equity return expectations require value realization within a holding period of 5 to 7 years. The Roosevelt's value is the product of a century of accumulated institutional significance that does not translate into the revenue growth trajectory that 5 to 7 year value realization requires. The hotel was eventually sold to a different ownership structure whose time horizon and return expectations were more compatible with the Roosevelt-specific institutional value profile. The Sazerac Bar is still there. The Blue Room is still there. The Starwood Capital holding period eventually concluded, as holding periods do. The Roosevelt New Orleans continues to operate as a Waldorf Astoria property, serving as the anchor of New Orleans' Central Business District luxury hospitality market and maintaining the civic functions that have defined the hotel since 1893. The hotel's ownership has passed through the institutional private equity structure of the post-Katrina renovation period into a more stable long-term ownership arrangement whose holding period and return expectations are more compatible with the Roosevelt-specific institutional value profile. What the Roosevelt case reveals in the context of this channel's 55 case archive is a failure category that complements the Helmsley Empire case, documented in Case File 046, and the Ritz Paris case documented in Case File 052. The specific tension between private capital's return expectations and the maintenance requirements of hospitality assets, whose value is substantially rooted in civic and historical significance rather than in financial performance metrics. The Ritz Paris resolved that tension through an auction that demonstrated the brand's extraordinary resilience and a renovation that enhanced the brand's physical expression. The Roosevelt resolved it through a renovation that restored the physical standard and a brand affiliation that imported the Waldorf premium into a market whose capacity to sustain that premium is structurally more limited than the markets where the Waldorf brand was built. The Helmsley Empire documented what happens when the controlling figure's personal conduct damages the brand that the civic significance had built. The Roosevelt documented what happens when the civic significance is genuine and the financial structure is nonetheless insufficient to maintain the physical standard that the significance requires. The hotel is still at 123 Baron Street. The Blue Room is still the Blue Room. The Sazerac Bar still makes the cocktail. The ownership structures that attempted to extract private equity returns from a civic institution have concluded their holding periods and moved on to other investments. The Roosevelt absorbed them all and remain. If this case file changed how you evaluate the relationship between civic significance and private capital in historic hotel finance, subscribe because the next case examines what happens when the civic significance is architectural rather than hospitality-based, and the private capital requirements are even more misaligned. And in the comments, given the Roosevelt's documented pattern of acquisition at valuations reflecting civic importance followed by operating performance insufficient to service those valuations, what specific ownership structure is most compatible with the long-term maintenance of a hotel whose value is substantially civic rather than financial? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.